This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Jim Woods. Jim is a financial journalist. He's with Traders Reserve. He has been a journalist, fund manager, stockbroker, and these days, he's going to say in the cast, he enjoys the writing perspective. And I wanted to have Jim on, not to necessarily have this big conversation about how to find absolute returns, but to talk about the market and the economy and uncertainty. To talk about the idea that things don't always go up in terms of the stock market, that is. And how can you think about the options and the possibilities and what might go wrong? Fun conversation. Like I said, I don't regularly do these types of conversations, but this was fun.
Good morning, Michael.
Hey, Jim. How are you?
I'm doing great. I know it's probably not morning over there, but it is here.
No, it's a little bit in the evening here, but that's the punishment that I have to endure for
for being a globetrotter, right?
Right.
That's not any kind of punishment.
This is my burden that I will struggle through.
We all want that struggle, man. Now, where exactly are you right now?
I'm in Thailand today.
Nice. Sweet.
I'm in Thailand. So it's interesting. I was here earlier in February, and I've had a chance to do quite a few speaking gigs, trying to spread the gospel, so to speak. So it's been an interesting trek, and I'm now picking up my gusto again on podcasts, and I appreciate you taking the time tonight to jump in and chat with me. And I should say, I'll let you give a little bit of an intro too, because you've got a little bit of a varied background, Jim. But we're going to talk today some. And you got a new book coming out called The Wealth Shield. But
it's actually out already now.
We're out already. I'm sorry.
Yeah. Nope.
But the bigger issue that I kind of really want to jump into is once we talk some bio, is that I usually don't talk about some of the things that you bring up, because in my world, the trend following world, you can, a lot of people can argue, hey, it's not really relevant. However, I think what's going to be fun about our conversation today is trading is one thing, but there's also societal ramifications. And once I let you introduce yourself to the audience, I want to jump right in and talk about the word ZIRP, because I mean this is near and dear to me. I mean, it has, from my perspective, it's not necessarily related to whether you're going to make money or not from a trading perspective. However, from a societal standpoint, it is poison.
Yes, no, I that's something I love to talk about, and perversely, it actually works somewhat in in a trader's favor, of course, as we've seen. But that's something that is the social implications, the political implications, the governmental implications are frightening, and that's actually part of what's at the heart of our service too. So,
well, how would you best describe yourself to the audience that might not be familiar with you and your work?
Well, I am, by background, I'm a journalist. I started out working at Investors Business Daily, the newspaper, and that's kind of where I got my first taste of a momentum trading, trend following kind of mindset. There, William J. O'Neill, who's the brains behind the company, made millions of dollars with a book called How to Make Money in Stocks, and his trading philosophy was based on a lot of trend following and momentum investing. And that's kind of where my foundation of this industry was rooted. I found that was a really interesting thing. And once I kind of wrote about it a lot and studied it and was able to become kind of a mini expert in it, I took those skills to a hedge fund where I helped manage this small, at the time it was a small hedge fund. We kind of got it to be a lot bigger hedge fund, fortunately. And then I took those skills to Morgan Stanley, where I worked for the firm for several years. And then I found myself more interested in doing the writing aspect of it, because that's kind of at the core of my heart. So I went back into the online journalism thing, the financial journalism thing. And basically I've been doing that ever since, writing and editing and doing articles for various websites, Street or Market Watch, A Street, Traders Reserve, Main Street Investor, several other publications Investor Place. And that's how I came to see this whole area of the markets where there was a lot of people talking about growth stocks, a lot of people talking about options and bonds and hedging and things like that. But I didn't see that there was a kind of a plan to make sure that your money was protected against all the governmental issues involved in that basically represent threats to our wealth. Part of that is the Fed, as you said, the zero interest rate thing, all of these things that are out there, so to speak, and they all have the potential to really harm your portfolio. But
Jim, let me jump in so we can start from the top. I think for a lot of people out there, look, I know there's a lot of bright people out there that could be doing very well in their career as a doctor, an attorney, et cetera, et cetera. But I think what's kind of happened, this idea of ZIRP, zero interest rate policy, why don't I let you explain what ZIRP is exactly, and we can kind of chat back and forth about it, but why don't you explain what it is and how we got there?
Okay, sure. Well, the zero interest rate policy is basically just the fact that the Fed is able to lend money to its member banks at virtually no interest rate, like 0 to 0.25% is the shortest term lending that takes place from the Fed to the member banks. And then because that rate is so low, the theory is that the rest of the banks that those banks lend to, like the bigger banks, like the Wells Fargo's, the JP Morgan, things like that, they're able to get access to a lot of easy money, low interest capital. So what that does is supposedly it juices up the economy by putting more money into the system. And in a way you could call it printing money, because the money doesn't really come from anywhere. It just kind of, the Fed just says, okay, well, we're going to take these group of assets on our balance sheet and allow you to have them here. And then they kind of buy them back from themselves in a perverse way. It gets kind of complicated, but the bottom line is the Fed just creates this money and puts it out there. And the whole thing kind of is based upon what's called Keynesian economics, and that because it's a kind of a hybrid of a government and private mixture of just putting as much money into the system as possible and trying to stimulate your way into economic growth. That's the basic idea behind it. That's
okay.
Why
let me ask you this though. Okay, so for the average person, you can think back to maybe the late 1990s. Maybe you were getting 5 or 6% on your money market account. Okay,
right. And now you get nothing.
Now you don't get anything. You don't get. I remember my CPA when I was first starting my business. He said to me, Mike, the magic number is 2 million free and clear. Get 2 million free and clear, and you'll get 6% a year. You're making 120 grand, and you're set.
Right.
And that, I mean, that doesn't exist at all anymore.
No, now you're making about 2,500 on that.
Yeah, but
at the same time.
What's really interesting though is that, have we got to the point, and I'm just curious your opinion, have we got to the point where all interest income can literally be eliminated with the wipe of a hand through the air. All interest income is gone, and nobody seems to raise a peep about it.
Yeah, well, nobody raises a peep about it. I mean, there's voices such as yours and such as mine, and there's a lot of other people that are very worried about this thing. But the idea that you can just take a balance sheet, or you can just take savers and basically throw them under the bus for doing the right thing with their money is something that represents a huge threat, because it makes you take on more risk in order to get the same kind of return that you used to be able to get. And that's the problem with it. And the whole thing goes back to, of course, like the entire banking system problem that happened in 2006, 2007, 2008. We all saw what happened there. That's one of the things that prompted this whole quantitative easing flight, which is the zero interest rate thing. And they're both handmaidens of each other. And that's the kind of thing that's the kind of transformational type of change that happens when governments decide to take a policy and kind of rewrite the rules. And then the regular investor is just left saying, well, how do I cope with this? What do I do? How do I protect myself against this? How do I get some kind of decent return? How do I make sure that my money doesn't get hurt when I go after those additional assets? And that's kind of one of the reasons why we created the Wealth Shield.
Well, here, let me just keep going with this ZIRP idea for a second, because I when I saw you were writing about it, it was one of the reasons I wanted to talk to you, because it's something that a little bit different from me than on the podcast that I do. And I think I'm not sure if I'm expressing this right, but it's almost like now that they've created the idea that you can no longer get interest income, nobody seems to complain about it because the stock market is straight up.
Yes.
But now here's the question I have. Each time, twice in the last 13 years when the S&P has cratered 50%, usually when the market is cratered, the interest rates have been relatively high. So my question I have for you is, what happens if we get another 50% crater when interest rates are at zero? Do we go to negative rates?
Yes, that's the thing. There's no more wiggle room for the Fed. And they can increase their quantitative easing. They can try to stimulate the economy with more massive money printing and just to keep interest rates at negative levels, basically. Like Japan, I mean, certain economies have done that in the past. But will it work? I mean, there's a term out there that says, "Is the Fed out of bullets?"
Right.
And it may be out of bullets. We've seen the economy respond in a tepid fashion over the last 5 years. Ever since quantitative easing, the market has been great because it's denominated in U.S. dollars, which have come under pressure. Not as much as many think that it has or that it should. But what we're finding, of course, is that the whole mandate of the Fed is more employment and a stable economy, and we haven't had that. We haven't seen the kind of bump in the economy or in the job market that we've expected to see, or that Bernanke expected to see. Some people, and myself included, did not expect to see a big bump in the job market, because the job market is not so much a function of access to easy capital. It's a function of confidence in the economy. It's a function of making sure that businesses are able to grow their business by investing in their business and hiring people and doing these things. And there's all kinds of reasons on a social level why businesses aren't doing that. They'd rather just buy their stocks back and lower the float and create bigger gains in their share price appreciation for their shareholders. And if I was running a company like that, I would maybe do the same thing.
Well, we also know from a structural standpoint, technology is arbing away the need for people. So it's amazing to me that the central planners in DC can sit there and say, well, let's adjust a few zeros here or there on our balance sheets. Let's do a little more easing, and that somehow or another that's going to make the structural idea of technology arbing away the need for people go away.
Yes, that's a great point. The thing, I think you hit the issue right on the head, because the whole thing is central planning has never worked. It won't work because the economy is much too complex for anyone to really begin to get their head around. I mean, we have all kinds of people acting in their self-interest, in the best interest of what they think their company should do. And no person in Washington, D.C., especially people who have never run a business like Bernanke or like President Obama or like just about anybody else in the Treasury Department, Geithner, anybody that's out there, is most people have not run a business. I mean, there's been some people that are in the business world that used to work for Goldman or Morgan Stanley or JP Morgan that now are working at the Treasury. But there's not a whole bunch of free market capitalists and entrepreneurs out there in Washington saying, yes, we really know how this is supposed to work. They're politicians or attorneys, and they have a different agenda. They have an agenda. And this is another thing that's kind of at the heart of this whole problem. Their agenda is not the same agenda as the average doctor, the average lawyer out there, the average businessman trying to make money in America. As a matter of fact, their agenda is at odds with your agenda. And that's something that we all have. That's one of the biggest threats out there, because when central planners play around with your life is at risk. And not so much physically, but your financial life is at risk, your freedom's at risk, and potentially your wealth, all the work that you've done all the years to create that wealth could just evaporate. And you brought it up brilliantly at the beginning. When it used to be, we were able to save money, put that money in a safe account and generate some real yield. But now we can't. So what do we do?
Let me ask you this. So I'm curious if you share the same belief. It's my belief that it doesn't really make a difference what party is in control these days. The things in D.C. Stay the same. And so you might have one party that openly says, hey, we would like to have the government be more in control and plan more. And you might have one party that says, hey, we'd like to have smaller government and we'd like to be less centrally planned. But it doesn't seem to make a difference. Whoever's in there, it all seems to be the same. And so from an investing standpoint, I really think the idea of waiting on DC to do the right thing is really fool's gold.
One thing you can count on, no matter who is in power, is that the power structure is not your friend. Because the power structure has a different agenda than you have. They might ostensibly say that they want to grow the economy and they want to make sure that Americans prosper. And I have no doubt that that's true in most cases. But the problem is, if government doesn't grow, then they have no reason to exist. And we've always seen this throughout world history. We've seen governments start, they become bigger, they become bloated, they borrow more, they try to expand more, either through empire or through the debasement of their currency that happened in the Roman Empire. And what happens is the empire collapses under its own bloated weight, and it can't support anything anymore. And then that's when the real pain happens to the society itself. And now there's tons of different examples of that throughout history. But the thing that I think we have to understand is, I always say this as a little encapsulation of the idea. I say the bigger the government, the smaller your wallet, because the government wants to grow at your expense, not with you. It wants to grow on your back, so to speak, because that's the only way it can grow.
Let me take it back to something on ZIRP, because I want to really want to kind of hone in on this point, because I still think for a lot of people out there, they know that interest rates have dropped. They know they're earning less interest income. Maybe they're not paying attention because the stock market has rebounded. So I think back to probably the mid-1990s. My grandfather had gotten Alzheimer's, and my grandmother showed me some banking statements, and she wanted to know what they meant. And back at the time, I guess they had a muni bond portfolio, and maybe it was yielding 7 or 8%. It was a really good yield. And now I think about I think about my grandmother's still alive. She's 97, but so she's made it. But I think about, let's say, folks today that are 75, 80 years of age. They spent their entire adult life. And I just want to kind of belabor this point because I don't think people are thinking about it. But let's say, they're 75, 80 years of age. They spent their entire adult life saving money, doing the right thing. And then right at the moment where they're hoping that maybe they could sit still and not feel a bit of anxiety for the rest of their golden years, the government just says, game over, people. We're throwing you under the bus. Maybe we're just going to kill you flat out. I mean, how many people have seriously, probably just from sheer kind of an elderly person who saved money their whole life, and then all of a sudden within a couple of years, they no longer have the interest income that they saved for 30, 40, 50 years to get. I mean, I'm sure some people have died of a broken heart because of this.
Well, that's the thing. Yeah, I agree with that. I mean, sorry to interrupt, but that's what makes this thing so threatening. It's not just about, well, I have less money I can't take as many vacations or anything like that. I mean, this goes to the core of a person's physical well-being. And that's one of the things I think that people are not realizing is that this is a threat to your life. This is not something that's just some kind of, idea that, a rich guy might not be able to buy a yacht or something like that if government grows a little more, if interest rates drop down a little further. This is serious, and this is something that I think every American should be really angry about, and they're not. And that's part of I think that's part of my goal, at least as a writer, as someone who's watches this stuff. I think it's important for people to realize this isn't just about your money. It's about your life.
Well, I think the anger would be there if the Dow and the S&P were not at the levels that they're at. And I'm not trying, look, as a guy who writes about technical trend following, I'm not sitting here trying to give anybody a trading strategy. I'm simply saying, from a societal standpoint, like you're saying, why are people not out in the streets? Because it's almost like what we've done, or the government has done, is almost like, hey, okay, we've taken your interest income away, but now we've moved the food bowl over to the other side of the room. And your heroin is now on the other side of the room, and you have to come over and eat from this bowl, and you have no choice. And it's almost like I think people are so panicked about what's happened in the last 5 years that they're almost like, okay, the stock market's back up. I'm not going to say anything. Let me keep my fingers crossed, and this is all going to work out all right.
That's exactly right. I believe that you have hit that nail right on the head once again, because if you're an investor and you're trying to beat the S&P, you have to be in the market right now because the S&P is going crazy. If you're someone who has lost a lot of money in the past 5-10 years because of the various blowups in the market, you may be not even back to where you were in 2007, 2008. You're barely getting back. Let's say you held an index fund over that time. You're barely getting back to where you were in 2006, 2007. You might have a little bit more than you did then if you just left it there. But look at all the heart attacks you had to go through for the last 5 years based on just hoping that money might come back at some point or another. So the government is basically engaged in a kind of a form of financial social engineering, saying, okay, here's the Fed, here's the ZIRP, here's the quantitative easing, and it's going to have ramifications for this sector, and this sector, and then that's where people are piling their assets. Well, what happens when you have a game-changing event such as zero interest rate or quantitative easing, and then you have a buying frenzy into these other sectors, like, for example, like treasury bonds and like stocks, and then you even have the most fundamentally unsound areas going higher, like say junk bonds. Junk bond yields are at all-time lows. All these things, these three components, tell you that you're in a bubble. And when you're in a bubble, we all know bubbles burst. Housing market bubble, the tech stock bubble. And when bubbles burst, lives are ruined. People get threatened. And one of the reasons why we created the Wealth Shield is to make sure that you're protected against bubbles bursting.
Yeah, it's as we're going to get into talk about that, but I want to kind of keep on this point for a second because I think you've got some really good insights and you give it kind of a very plain spoken voice that people can understand. There's another issue to ZIRP that we've not talked about as well, that it's the elimination of principal. This is forcing people to spend down their savings at a rate they never anticipated. And not only is it forcing, let's say, the generation at 75, 80 years of age right now to spend it down, I'm surprised also that their heirs are not sitting back and saying, hey, hold on. All that money that mom and dad and grandma and grandpa saved, they're being forced to spend it now.
Yes. I mean, these things, I'm glad you brought that up because not only is that a situation where people's family wealth is coming under attack, but what we're also seeing is because the Fed is basically enabling the government to borrow more money and borrow money from by selling treasury bonds at very low interest rates. They're also creating a huge debt that our grandkids are going to have to pay. And that means more taxation or higher interest rates or both. And that means more of a stagnant economy down the road. I'm talking 10, 15, 20 years from now when grandkids are starting to go in the job market. What's that job market going to look like when there's massive debt and no interest rate income and nothing there in terms of economic prosperity? What's going to happen then? What is the society going to look like? Are we going to be more free or are we going to be less free?
As we keep talking about this, I just want to, there's so many issues that go with this. And I like this conversation because people don't look at it and it's three-dimensional. There's a lot of different things going on here. Let me pose you this. If rates go up, and I want the audience to think about this too. If rates go up, if rates went back to, let's say, late 1990s or even mid-2000s, 5-6% for your money market account, everybody, where do you think the stock market's going to be?
Oh, my God. The stock market is going to be in tumult. And people who own bonds are going to be in tumult because the bond prices will go down. Even though, I mean, if you go ahead and buy new bonds, you might get a little bit more yield. But what if you own bonds now and the value of those bonds have gone up substantially and all of a sudden the price goes down because the yield goes up? And what about the market? What if companies have to pay 5-6% to get money? What's that going to do to their bottom line?
What's the value? The value of real estate? I mean, everything.
The value of real estate is going to be incredibly damaged. I mean, right now there's a revival somewhat in the real estate market, and that's all been great over the last year and a half. We've seen, people buying homes again because interest rates are low and because the banks are starting to somewhat loosen up their standards for people with a down payment and with
but isn't this what happened in 03, 04, 05, 06 is what got us to the problem we begin with?
Well, that's the thing. I mean, it's the concept of blowback. You do one thing, you will lower interest rates to near zero, and then people can start buying homes again if they're qualified. But what happens when that interest rates go up and then people can't buy a home anymore? The value of home prices are going to go down. And then what's the government going to do then? Say, oh, well, we can't raise interest rates. So what are we going to do? Put more incentives to people to buy houses? We're going to put pressure on lenders to lend to less qualified people. And in fact, that's already happened. We've already seen some rumblings of that where the government has basically said, we need you to kind of lend and expand your lending standards or lower the lending standards somewhat to include more home buyers in the system. Well, what are they doing? They're artificially intervening in an area where it's just going to cause more blowback, just like we saw years ago I mean, the story is not hard to figure out if you are looking at it from more than just a focused prism on what's going on right today.
Yeah.
And that's the problem too. It's these things all have blowback, and these things all can damage someone's wealth in a serious way. We don't know exactly which way it's going to happen. This whole ZIRP thing is an unprecedented experiment. No one knows how it's going to turn out, whether it's going to turn out in massive inflation, hyperinflation, possibly then deflation. We don't know. So that's why you have to be prepared.
You know, and I think that's why I was interested in having this conversation, not because I want people to say, oh, Mike Covel is now some newfound fundamental economist armchair quarterback guy. No. That's not my point. My point is to have this discussion honestly and say, what are these factors that are going around? What is being done by the government? What have we seen in the past? And I've said this just in speeches in Asia. Can anybody in this room, can you imagine the S&P going down 75% and staying down for 20 years, 75% down? Of course you can imagine that. Why can't you? The same thing happened in Japan. It could happen in America too. And so I guess the idea with this conversation is to say, if it's easy to imagine all kinds of volatility in the future, if it's easy to imagine all kinds of uncertainty for the future, then what's your plan?
Exactly. Those without a plan to cope with these things are going to be the ones who literally are destroyed financially. If you just have a bunch of stocks, you just have a bunch of bonds right now, you are not protected against waking up one morning and seeing the S&P down 500, 1,000 points, or the Dow down 500, 1,000 points. I doubt the S&P would be down that far, but you know what I mean. We all know that we could see this market even if the Fed decided to raise rates just a little bit. I mean, even when they hint and start to pull back on quantitative easing, we see the market down 100 points, 200 points maybe. And so if just a hint of it is going to cause people to worry, what do you think is going to happen when there's actually a need to start raising the rates?
Yeah. Well, I want to jump in and let you go ahead and talk some about what you and your partners have put together to let people, and it could end up being slightly different than what I talk about from trend following perspective. But I think what you guys are doing is more of a financial planning service and getting people to look at this, not necessarily about how much yield you can make, but I think you're trying to get people to focus a little bit more on all these unpredictable, uncertain areas and just protecting what you have. Am I mistaken?
No, that's exactly right. Basically what the Wealth Shield is, it's an informational tool. It's for self-directed investors who, similar to what you described earlier, people that have been investing 20, 30, 40 years, they've accumulated some decent wealth, and they want to make sure that wealth doesn't go away because one day we wake up and the Fed decides to bump up rates, or one day we wake up and we realize that Europe is collapsing and now we have no access to our to the European equity markets or something like that. So we decided to write the Wealth Shield book, which is available at Amazon.com. And we also decided to create the Wealth Shield service to help people cope with this idea. And one of the things that's at the root of our service is we want to make sure people look at these things with a preparedness mindset. I mean, think of it like approaching protecting your home from, let's say, I live in California. We have earthquakes here all the time. So one of the things you want to make sure you have is spare water, spare food, plenty of batteries, plenty of lights, things that can help you weather an emergency. And it's the same thing with your money. If you have some money and you are trying to protect that money, you have to be prepared for all various sorts of emergencies. And that's one of the things at the heart of the Wealth Shield. And we do that through what we call enhanced diversification, or diversification 2.0, if you will. So it's not just your basic diversification plan where you put some of your money in bonds, some of your money in stocks, some of your money in cash. We like stocks and we like certain corporate bonds, but it's much more diversified than that. Our kind of model portfolio spreads your money out so that you have access to it wherever you are. And you make sure that you have certain assets in your portfolio that maybe some will go up at some point, some won't go up at some point. But as a whole, the portfolio will allow you to weather like basically any kind of major meltdown that takes place.
Let me throw something at you as you're talking about the eventuality mindset. It's becoming harder and harder as an American to have capital leave the borders of our country.
Yes.
I mean, to me, it's starting to almost feel like a prison banking system.
Yes. You used to be able to, I mean, one of the most attractive things in the past was a Swiss bank account. Now, forget about it. You cannot, if a Swiss bank account doesn't help you at all. Swiss authorities will report what they have. The government can have access to that as easy as they can have access to your Wells Fargo account. So you do not want to have a Swiss bank account. One of the things that we advocate in the Wealth Shield is having what we call a global cash stash, which basically is just investing in currencies besides the US dollar. But you're not really investing in currencies per se. You're just taking advantage of the fact that some currencies are trading higher in value than relative to the US dollar, like for example, the Aussie dollar or the Canadian dollar, Norwegian krone. Those kind of things are all things that most investors don't really kind of picture or don't really think about when they're trying to protect themselves. They just say, well, I'll just have a little bit of cash. Well, what happens if your dollar value goes down because of all the zero interest rate policy and this quantitative easing, which is what many people think is going to happen. So one of the things we actually call these things money blocks. And they're basically like 6 areas where we think investors should go into. And one of the ones that we think is different is the global cash, because you want to own things that are not necessarily correlated to US dollars. You want to have, let's say, an Australian CD that pays you a decent amount, plus you're able to convert that into US dollars at some point and get the benefit of having the higher value of the Aussie dollar. So just these kind of things are things that people don't really tend to think about when they're investing, but they need to start thinking about it because that's how you protect yourself.
No, of course. I mean, I think the important point you're raising is just the idea of trading in currencies. I mean, for example, in my world, in the trend following world, trading currencies is a normal course of action.
Yes.
I like, even though the exact strategy of how you might get clients to think about trading currencies compared to a trend following strategy could be different. I think the important issue is that from a wealth protection standpoint, and I think that's the real focus of this conversation today. I don't think either of us are trying to tell people during this conversation, hey, here's the best idea for absolute returns. I think we're trying to have that nice, honest, frank talk about what can go wrong with what you've got and how do you protect. If most of your assets are denominated in dollars and the dollar slides massively, or as we keep talking about ZIRP, if ZIRP keeps going down and down and down, there's not much more way it can go except the negative. What are you doing to protect what you've got?
Exactly. That's at the heart of the Wealth Shield is protecting what you got. I mean, you just think of the name itself, the Wealth Shield. We want to build a shield around your money so that if the dollar crashes, you're not sitting there holding money that's worth less in terms of purchasing power than you ever thought you were going to have. You need that purchasing power to live. So why not have a little bit of that money in a global cash type account? Of course, one of the things that we advocate in the Wealth Shield and that we're not afraid to buy stocks in any way. And we similar to kind of the trend following thing, we want people to be in the market participating in stocks, participating in the best of the best kind of stocks, the kind of stocks that are going to be doing well no matter what happens in Washington, D.C. People are always going to need to buy things. People are always going to need to go have, they'll want to go to buy products from J&J. They want to buy things from Amazon.com, things like that. We want people to follow the trend in the sense that they're participating in the upside that's presented to them. But you can't just do that, because what happens the day that stops and you're sitting there left with no recourse but to hope that the market comes back up.
No, I mean, we've all got to have a stop loss on our portfolio. I mean, that's one of the best risk management tools we have. I mean, at the end of the day, I still think about a quote that I put in my first book from a money manager who was he was trading Enron, and Enron was around $90 a share, and Jeff Skilling left around $50 a share, and this money manager was holding on to Enron all the way down to $2 a share. And he was complaining that he had no way of knowing, because the balance sheet was perfect. He didn't know the trading floors were fake. And I'm thinking to myself, now hold on, you still actually held this stock from 90 down to 2? I mean, so ultimately there has to be a stop loss point, for people.
Right. No, that's the thing that people. The stop loss is a fantastic way to protect your downside, and specifically in any one position. It always amazes me. I mean, my basic training at the beginning of my career was all about buying stocks when they broke out to new highs, but also putting a stop loss on that position to make sure that you didn't lose in more than like 7 or 8% in any one position. Now, this is more of a trading oriented kind of philosophy. It's not necessarily something you find in the Wealth Shield, but the point of protecting yourself on the downside is super important, because you don't know, nobody knows what is going to happen in any given stock, in any given industry. You have no idea. No one can predict the forces that kind of push down a stock, push up a stock. Like the manager that you said that rode the stock from 90 to 2. Didn't he watch the stock come down on the charts? I mean, was he just oblivious to the fact that the price was coming down and his clients were losing money? He must have been, because he wouldn't have sat there and rode out that negative trend so long. So you have to be aware of not only the trend, but also the trend in the wider like kind of picture of things. So you have to be aware of a ZIRP. You have to be aware of QE. You have to be aware of governments around the world debasing their currency, racing to make sure that they keep up with the Joneses and destroying their own currency, like the way Japan's doing, the way the ECB is doing, and the way Bernanke is doing. So all these things represent potential threats. So how do you deal with the threats? Well, you diversify accordingly.
But, Jim, one of the places people can get more information at thewealthshield.com, and I'll mention that at the end of our talk as well, too. But I want to kind of pick your brain a little bit on the idea of if, because life is all about uncertainty and you have to kind of think through the possibilities. Right now, you have U.S. stock markets at record highs. You have interest rates at record lows. If the stock market in the United States of America was to drop down some significant amount, if we were to have another 50% meltdown in the S&P, it's happened twice in the last 13 years. It can surely happen again. If that was to happen while rates were at zero, I mentioned this earlier, what would be, in your opinion, the chain reaction that might be seen that people should be thinking about from a planning perspective?
Well, the first thing you're going to see is if you're heavily allocated to stocks, you're going to see the serious pain right there, of course. But more so than that, you're going to see the more a move to monetize all the debt that we have by the Fed. And what's that going to do? That means the Fed is going to take on all the debt that the government has. And it means that massive money printing is going to happen, akin to something like the Weimar Republic type of inflation is probably what you're going to see. I mean, that's just a hypothetical. We don't know if that's going to happen. But what happens when that does happen? Everything is going to be under assault. Your dollars are going to be under assault. Any amount of assets that you have, that you've saved, or your savings is not going to be worth anything because the purchasing power is going to be destroyed. About the only thing that would save you in that case is some precious metals. And that's one of the things that we advocate investors hold as a wealth protection tool, because that is something that the powers that be can't destroy. Physical coins, physical silver, physical gold, things like that. So that's the scenario that's the kind of almost the doomsday scenario that you want to plan for and hope that it never happens. And most likely that kind of thing won't happen. But what if it does? What are you going to do? Are you going to just kill yourself? Or are you going to be prepared with protecting your wealth from looking at it from various different aspects, having that global cash stash, having a little precious metals, things like that? That's the kind of mindset that we want to help people cultivate, because it's not enough just to put your money in the market and hope that it doesn't go down. You need to be able to protect yourself from that. Now, interestingly, like you said, we've seen big corrections over the past. And I suspect that corrections like that are going to be more frequent and maybe even more violent. And the reason why is because nobody knows, like I said, nobody knows how this big, huge experiment of easing is going to eventually shake out. We were liable to see plenty of aftershocks to this thing for years and years ahead. And if you want to survive it, you have to be prepared.
Well, now, for example, we're kind of having a negative conversation here, but I saw the first quarter, JP Morgan had profitable trading days, 63 out of 63 days. So, it depends on from which seat you're looking at. I mean, some folks are using the whole idea of what the Fed is doing to make great amounts of money.
Yes, no, that's true. And that's an important thing. You want to take advantage of kind of what the world gives you. I call it beating the bastards at their own game. Because if the Fed's going to give you easy money, you want to participate in that. You don't want to just sit around saying, well, I don't trust this. It's not going to be any good. I'm not going to participate in it. No, you want to act based upon your own self-interest and based upon the circumstances that are provided to you. Any person that is good at what they do will take advantage of the circumstances around them and maximize that. But you also got to know that things can turn, and they can turn very fast. And that is why you want to be diversified. That's why you want to make sure that you don't put your eggs in one basket, as the old saying goes. Because one day those eggs could all break, and then what do you have? Nothing.
Well, I think the flash crash was a great example of that too. And I'm not a perma bear or anything. I'm just kind of looking at this and trying to stimulate the conversation, stimulate the dialogue, and get people to say, "What if? What could happen? What could happen?" Because there's when the stock market's at record highs and interest rates are at record lows, it's a pretty taut string there. It's a tightrope. And as I've said to a lot of audiences in Asia, a lot of value-based fund managers, they don't really want to hear the trend following discussion until I look at them square in the eyes and I say, "Oh, but can any of you not? You can all imagine there's another black swan out there circling," as I point out the window of the current skyscraper I'm in and whatever city that I'm in. And I say, there's a black swan out there circling, looking to land. I can't tell you when. I can't tell you how. I can't tell you what building it will land on and who will get blown up. But it's coming, and we all know it. And your strategy is not prepared for it. And that's usually where most people really sit up and listen, because they say, you know what? You could just see in their body language, you're like, shit, we're not prepared.
Yeah, the smart ones will listen. And the ones that want to deny that black swan is flying around are the ones who are going to get crushed when that black swan breaks through their veil and starts to have them for dinner. Now, the thing that's interesting about that is there's so many black swans out there. And now more than ever, there's black swans kind of circling around the bone, so to speak, of the economy, because it's so fragile. things are fragile. Things we know, like you said, interest rates, all-time lows, stock market, all-time highs. How long can that last? Historically, it won't. So what are you going to do then?
Well, listen, one of the places that the audience can go and check out, I want them to go to your website, thewealthshield.com. And I know they can pick up your book there. They can reach out to you if they want to talk more. And like I said, I think your service is more about getting people to not necessarily think about their absolute returns, but how can they protect what they've got?
Exactly. That's the essence of the Wealth Shield. And the essence of the Wealth Shield is making sure that you are prepared for whatever black swan comes your way. What you don't want is to have that black swan ruin your life. That's what we're trying to help people do.
Listen, I love these kinds of conversations because I can get into it really fast. And like I said, I don't do this regularly on my podcast, but I think it's a good conversation for people to be thinking about because I just don't think it's one that's had regularly. And I think as long as the stock market is at record highs, people are like, oh, everything's okay now. Everything's okay. You know, it's like that old, was it Ginger Rogers, the old song from 1930s, you know, we're in the money now, you know. It's like just dancing away up on Broadway, and I think there's a little bit of that attitude right now, and I think you know, and I know that usually when that type of attitude starts to happen, you know, like a recent cover of Barron's, a bull on a pogo stick jumping up and down with a big grin on his face. When that stuff starts to happen, everybody, you should kind of pause and say, okay, hold on. It's not about trusting your gut, but just realizing psychologically that you better have a strategy because the good times don't, at least the stock market up move, good times don't last forever.
Right, exactly. And the key also is, if you play things correctly, the good times, you can take advantage of the good times, but you can also make sure that you don't get crushed when the bad times come, because they do come and they will come. Yeah.
Let's end it there. That's a great line to end it on. And once again, Jim, people can reach you at thewealthshield.com, and we will have to talk again. I enjoy getting into these kinds of conversations every now and again. So I appreciate your time today, Jim.
My pleasure, Michael, and I'm a big fan of your work, and I'm just a little jealous of your globetrotting ways, but hopefully I'll get there at some point.
Jim, take care, and we'll talk soon.
Thank you, Michael.
Okay, take care. Bye-bye. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.